What we've seen since 2018 when we launched the business are drastic revolutions within the corporate bond market. In 2021 alone, we saw the rise of portfolio trading. In 2022, we saw the rise of algorithmic trading and electronic trading. But to see two of them happen in subsequent years, I think that is quite amazing to see.
Rob and Paul, always exciting to talk quantitative fixed income with you guys. When we say we employ a quantitative approach to fixed income, what exactly do we mean by that? And how does that differ from traditional discretionary strategies?
The vast majority of fixed income assets across the entire market are managed by traditional discretionary processes. And when you have such a huge market skew towards one process, that creates a lot of market inefficiencies. And we have the opportunity to do things differently. We can apply a fully systematic process in order to exploit those human biases that are ingrained into those traditional discretionary processes.
And we often get asked, what does that mean? How does it work? There's a lot of different parts that go into an investment process, from trying to identify what securities are most attractive, which capital structures are most attractive, to risk management, to transaction costs, liquidity modeling, and putting it all together in terms of portfolio construction. We've made all of those parts of our process fully systematic, which is really a differentiator from our point of view.
When people think of quantitative strategies, they often think of equities first. And obviously here we have decades of experience on the equities side. Now, how do we leverage that expertise that we've built up over time?
We've been building up databases for many, many years on the equity side. Being able to leverage all of those day one within the fixed income approach has been tremendously advantageous. With that said, there's no free lunch in this case, where there's a lot of work that goes into identifying the credit specifics and a lot of nuances specific to the credit markets. This is an area where we've been able to leverage cross-asset class signals, a lot of data techniques as well in terms of machine learning and others, and been able to put it to use in fixed income markets.
When we first launched our quantitative fixed income business back in 2018, we first launched with high yield. Since then, we've expanded to other segments of the fixed income market as well. What segments would you say are most conducive to employing quantitative approaches?
Yeah, we started off in high yield, as you highlighted, where we thought there was a really good opportunity to be able to apply our security selection models into the fixed income market that had high idiosyncratic risk, which is the high yield market. Since then, we've been able to apply our same process and extend our same insights into things like investment grade markets or even government bond markets, and most recently, the securitized market. So I think there's a huge, strong value proposition to be able to apply our process across many different types of fixed income instruments.
So clearly, it's a very exciting time for quantitative fixed income. What has you guys most excited now?
We're very excited about the future of systematic strategies within the fixed income market. What we've seen since 2018 when we launched the business are drastic revolutions within the corporate bond market. In 2021 alone, we saw the rise of portfolio trading. In 2022, we saw the rise of algorithmic trading and electronic trading. To see two of them happen in subsequent years, I think that is quite amazing to see. And those types of market structure changes will continue to evolve at a rapid pace within the corporate bond market.
And from my point of view, the models have worked over the years. Implementation was always so much the challenge. I think now we're finally in the golden years for systematic fixed income.
Paul, Rob, thank you for your time today. It's always fun talking quant fixed income with you.
Thanks for having us.
Yeah, thanks a lot.